Welcome back. You're watching Invest Africa, and still with me in studio to take a closer look at the business and investment opportunities in Africa's tourism industry are Michael Tatalius. He's CEO of the Southern African Tourism Services Association, and from our bureau in Lagos, Danny Kuperoglu joins us as well. He's the general manager of Eco Hotel and Suites. And joining us now on the line from even Cyber City in Mauritius is Sen Ramsamy. He's the head of hotels, leisure and tourism at KPMG Mauritius. Sen, thanks so much for joining us this afternoon. And I guess perhaps apt that we've got you on the line from Mauritius because the tourism space, a major revenue earner for the Mauritian economy. Let's take a look at the status of the industry right now, because of course this within a very challenging global economic environment, and we've had the industry facing headwinds at large. What kind of investment appetite is there within that space right now?
Well, thank you very much for giving us the opportunity to participate in your program, Alicia. Hello, good evening, Africa, from KPMG Mauritius. Tourism has been one of the economic engines of Mauritius for a number of years. We started some 60 years ago, and so far, tourism has been a rather success story to Mauritian economy. But after 60 years of good performance, I must say that the product is reaching some kind of maturity, whereby the product life cycle is being put into question again. In terms of investment, right now, we are focusing on infrastructure a lot in terms of a new airport terminal which is going to open this year. We are restructuring the tourist office for the promotion of the island all over the world. There is an Africa Center of Business Excellence which has been created, whereby investors could use Mauritius as a stepping stone, as a base to add value to their project and then coming to Africa. And obviously we are doing market diversification plan, which is very forceful, especially focusing on the emerging markets like China, India, Russia, and other similar countries.
Mm-hmm. Is the regulatory environment, Sen, supportive enough of industry as well? Because not too long ago was the cost of business highlighted as a key factor eroding some of the sentiment over in Kenya, for example. We had hefty taxation, a challenge hampering trading conditions on that end. Is government in Mauritius supportive enough of the industry and forthcoming with incentives that would be attracting investors its way?
Well, obviously, we have the Board of Investment in Mauritius, which is giving a series of incentives to investors worldwide to come into Mauritius, and also to come into Mauritius to step into Africa, where we add value into those projects. Yes, government is supporting also the local operators in terms of incentives, in terms of tax concessions, but also in terms of land allocation, whereby they can construct hotels and develop their own projects with incentives from government. Besides this, there is also a full plan for marketing, whereby government accompanies the private sector and other operators onto the market so that we can attract the maximum number of visitors onto Mauritius. Yeah. And unfortunately, because of the crisis in Europe right now, which has been our main market for the past number of years, tourist arrivals from the European countries has been a bit sluggish as compared to the new markets where performance has been doing excellently well.
Sen, let's leave it there with you for this afternoon. Thanks so much for having joined us on the line. Sen Ramsamy, of course, is with KPMG over in Mauritius. Back to our guests in studio right here in Johannesburg and in Lagos as well. Michael, let's pick things up with you here, because earlier on you were talking about ground rules needing to be established, and with that comes an assessment of the entire playing field as a whole. I mean, is there a distinction to be made, firstly, between local and foreign investment that's directed our way, and is there a distinction to be made between your smaller and your bigger players, you know, because you've got your SMEs and then your bigger established brands that you highlighted a little earlier as well, all in this together, because that should give us a sense of just how competitive a landscape we're looking at here and what kind of muscle you need to be a part of it.
Right, well, it's tricky. If you're going to build a 6,000-seater convention centre that Danny was talking about in Nigeria, you're going to need a lot of capital. That's not a small player. But they may well be, what you've got to look at is what opportunities are there for smaller business to supply to it, cleaning staff, feed, sheets, laundries, etc. there's often quite a lot of these smaller businesses can feed off the bigger investments. So it doesn't necessarily have to be that you have to stop, and sometimes governments get a bit confused. They see that sometimes the need to stop big investments because they think these small guys aren't getting a chance. By setting the ground rules, we're trying to set up and say, if someone does invest, whether it's a local or as a foreigner coming into the country, or as a foreigner who now lives in the country and wants to bring some more money in to invest, they must be able to get their money out in terms of their profits. They need to know what the taxation rules are, and they need to know that they're going to have rights to hold that land. You don't want to come soon after you built a piece of land 2-3 years down the track and someone comes strolling along and says, by the way, actually you don't own that piece of land, I do, and now you have a whole ownership fight. That creates huge instability and chases investors away. And I certainly see this when I talk to the hoteliers from South Africa who are looking at places in Africa. There are probably about 10-15 spots they'd like to build in, but there's not clarity on a certain number of issues, including land, tenure, rights to access and what have you. So they're choosing the 4 or 5 spots that they think they're comfortable working with from a legal point of view. So you've got to get it where the government says, in terms of our broader investment drive or drive to attract investment into the country, tourism is no different. These are what foreigners can do. They can bring money in at the sort of following rates. They would have to own tenureship on a 99-year lease or 15, 20, 30-year leases or whatever the process is, but then it mustn't change. Now, we see a little bit of instability happening, for example, with the whole land redistribution process, how everyone views it, in Zimbabwe. A lot of tourism there was pushed across the border into Zambia, and Zambia got a boost in tourism. There was a lot of people still wanting to have a similar sort of product. So you saw investments in Livingstone. Victoria Falls was able to sort of muddle its way through, and Victoria Falls as a sort of a spot was able to keep itself stable and keep investors coming and keep tourists coming. But Livingstone definitely benefited, and a whole lot of wildlife destination products along the Zambezi River benefited in the Zambian side. So when you get instability, people will withdraw their investments or keep them to a minimum. So what we're looking for is government to just set along the sites. What is it you're going to do? And then, are you going to try and do any incentives? Are you going to do incentives to get people to invest into the further rural areas? If you take the South African advantage situation, government doesn't really see the need to encourage you to invest in building another hotel in Sandton. There are enough entrepreneurs doing that already. But we see the need to want to get people to invest in other provinces where the rural product is and where the jobs are needed. Then they have to come up with incentive packages which have to be easily understood, fair, accessible, and the rules have to be quite clear. Then people apply for them, they must get them according to the rules. So again, whatever the government chooses to do, it must do fairly and it must do consistently, and it needs to keep a sort of a 20 to 30 year view. It can't be chopping and changing every 2 or 3 years. Investments of this scale need a 20 or 30 year view, and that's what you need to be encouraging.
If we assess the competitive landscape over in Nigeria, Danny, I mean, what are we looking at exactly, and how do you rate barriers of entry into this sector? And once you're in it, what are some of the challenges that actually impedes sustainability?
I think we focused a little bit more into hotels and hospitality at the moment rather than tourism in general. The main challenges in Nigeria when it comes to entry would be the capital and the access to capital, because of the cost of the capital. We're talking about borrowing at 20% at the moment, which is at some point for real estate might be even unsustainable. And however, we see a lot of private investors that they believe that it's good for them to invest their money in the sector. And that's the reason why recently in Lagos we have seen all the South African chains being there and expanding with local partners, of course, local owners. So we have the Proteas, we have the Southern Sun, we have the Sun International Legacy Hotels. Everybody's here, and also international chains. We have Intercontinental here now in Lagos. We have Hilton expanding even regionally in places like Akwa Ibom and places like that. We have Marriott coming very soon. So it's obvious that they see something in the economy and they are prepared to invest.
Absolutely.
However,
to end off things with you, Michael, on this end, I mean, are we putting our value proposition on the table to the extent that we could be? Are we marketing our story enough as a 21st century tourism destination?
I think we are, actually. The one thing that Africa does very well is marketing. We have to sit back to no one. You just see how many advertising awards we win around the world. We're good at marketing. Part of the problem, though, is the cost of, Danny's talking about the cost of capital. There's also a cost to this whole process in terms of the cost of getting the tourist here. And then you're dealing with other government-led issues, and it's things we're shooting ourselves in the foot about: air access and visas. We constantly make it difficult for people to enter our country. So
Expensive
and difficult to enter our countries, and don't make it easy for them to travel around in the region. Remembering, a foreign tourist who's coming to South Africa can't tell the difference between Cape Town, Vic Falls and the swamps. They think they're in the same sort of country, because in Europe you can just travel quite easily once you've got your Schengen visa. So sure, there's needs to protect the access to the country, but you need to make it logical, cost effective and effective for the whole region. Air access is the constant bugbear. If you can't get people in on aeroplanes, how are you going to run an industry?
Let's leave it there. Michael, thanks so much for having joined us in studio today, and to you, Danny, for joining us from Lagos. We've come to the end of this edition of Invest Africa. Of course, Michael Titalius from the Southern Africa Tourism Services Association with me in studio, while Danny Kuperoglu is of Eco Hotel and Suites in Nigeria and joined us live from our bureau in Lagos, Nigeria. Until next week, from me, Alicia Seckham, it's goodbye.